Tech is in the spotlight as investors do question whether or not the market's recent standouts are going to continue to lead the way higher in the second half of the year. Our next guest still sees upside ahead for this sector and expects AI to catalyze the broader tech rally. Joining us now to talk a little bit more about this, we want to bring in Scott Devitt. He's Wedbush Securities Managing Director of Equity Research. Scott, it's good to see you. So I think a lot of people are questioning what exactly that upside looks like here for tech and these quote unquote market darlings here of the last several months. What do you see the second half of the year shaping up like?
Well, good morning. And, it's been an interesting ride post-pandemic. 2022 was a very difficult year for these companies, and they're all getting back to their normal states now in terms of run rate revenue growth with operating margin expansion and, generally speaking, more disciplined management teams because of 2022. And so while the performance of these larger internet and broader technology companies has been strong, the past year and a half, the multiples are not extremely high, relative to history and relative to other industries. So we still very much like consumer internet and specifically Amazon, Alphabet, and Meta in terms of the mega caps. And we think the underlying trends and fundamentals of the businesses are as strong as they've ever been.
Yeah, it'll be interesting to see what we get from this quarterly earnings cycle in terms of data around how much the investment on Gen AI from those companies is going to actually lead to any tangible revenue that we can see. Can you talk about what you are expecting in terms of who might be the winners and losers based on the amount of CapEx they've put into AI and who will be able to prove out that investment this quarter?
Well, it's early days. NVIDIA can clearly prove it out. They're selling the chips to all the hyperscalers right now. The companies, that I follow, certainly Amazon and Alphabet, given that they have data center businesses that are selling into the corporations, that are going to be actually utilizing AI, you're going to start to see benefits there. Microsoft's already seen it. Alphabet and Amazon have been a little bit further behind, but I think you could see some quantification of revenue contribution from AI from those two businesses. As you mentioned, both companies and Meta are spending aggressively on AI, data center wise, in terms of serving customers for Alphabet and Amazon. And for Meta, it's in terms of the spend to try to generate revenue over time in their consumer facing businesses. So that's the one caveat here, that costs in the short term don't get out of control as we await the revenue contributions. And I'd say that's probably risk number one in the back half. But I do think, the market is very excited about AI, and to the extent that the underlying businesses remain fundamentally strong otherwise, that they're going to get a pass for the time being. That may change in 2025, but for the next 6 to 9 months, I think these companies still have a pass.
Scott, I'm curious what you make just about the argument of some of those rich valuations of big tech, of AI. Yes, earnings growth has been supportive, but the bar has been set very high this earnings season, especially looking ahead. Is that at all a concern just from a valuation perspective?
Well, they're high relative to history. They're not very high. Like Meta's a mid-20 times forward gap earnings multiple company, and Alphabet's slightly lower than that. Amazon's 33 times. And I love Costco, but Costco trades at something like 45 times. And Amazon's a quite different, more dynamic company in the end than Costco. And so, you have to take a step back. It's always easy to sell winners after good periods of performance. And we've definitely, probably overanalyzed this in terms of making sure that we're comfortable sticking around. But, what I think here is that the fundamentals are strong. The underpinnings of AI, while still in question in terms of revenue contribution, are not going to be necessary, for still a little bit of time. And these valuations, whereas they're elevated relative to history, they're not really expensive relative to other industries. And I'm speaking specifically to my coverage area, which incorporates Amazon, Alphabet, and Meta. When I look at other industries, they're just not high multiples.